Welcome back. In this lesson, we examine the activities associated with primary markets. Let's go. By now, you should be familiar with the key distinction between primary and secondary markets. Primary capital markets refer to the sale of newly issued securities. If it is the first time that the company is issuing shares to the public, the issue is called an initial public offering. Otherwise, the issues are called seasoned offerings or secondary issues. Later, if investors trade these securities among themselves, they trade in secondary markets. A primary offering can be to the public or as a private placement to qualified investors. Public offerings by companies are almost always sold with the assistance of an investment bank. The issuer provides information about its finance and prospects, as well as how the funds will be used. The investment bank disseminates this information to interested investors and gets preliminary agreements to buy part of the issue. These are not actual orders, but are referred to as indications of interest. The investment bank adjusts the number of shares to be offered based on this. The process of gathering indications of interest is referred to as book building. In London, the book builder is referred to as the book runner. In Europe, an accelerated book build occurs when securities must be issued quickly. The public offering can proceed through an underwritten offering or a best efforts offering. In an underwritten offering, the investment bank takes the role of an underwriter who agrees to purchase the entire issue at a price that is negotiated between the issuer and the bank. For large issues, a syndicate of investment banks and broker-dealers helps the lead underwriter build the book. If the issue is priced too high, it may be undersubscribed. In this case, the investment bank must buy the unsold portion. In the case of an IPO, the investment bank also agrees to make a market in the stock for a period after the issuance to provide price support for the issue. If it's priced too low, the issue may be oversubscribed. Not every investor gets the amount they applied for, which may mean that the issuer is not getting a fair deal. In an underwritten offering, investment banks have a conflict of interest. As the issuer's agents, they should set the price high to raise the most funds for the issuer. But as underwriters, they would prefer that the price be set low enough that the whole issue sells. This also allows them to allocate portions of an undervalued IPO to their clients. This results in IPOs typically being underpriced. Interestingly, some issuers may also prefer underpricing the IPO because oversubscription and the subsequent trading above IPO price is good publicity for the firm. Such an IPO is referred to as a hot issue. Another form of public offering is a best effort offering. The investment bank does not commit to purchase the whole issue. Rather, it acts only as a broker to issue the shares to interested investors. If the issue is undersubscribed, the issuer may not raise the desired amount. In a private placement, firms sell securities directly to a small group of qualified investors, usually with the assistance of an investment bank. Qualified investors are those with substantial wealth and investment knowledge. Private placements do not require the issuer to disclose as much information as they must when securities are being sold to the public. Therefore, the issuance costs may be lower than public offerings. However, investors are likely to require higher returns, meaning a lower price, as the securities are less liquid, as they cannot be traded in an organized secondary market. Besides public offerings and private placements, other activities in the primary market include shelf registrations, dividend reinvestment plans, and rights offerings. In a shelf registration, a firm registers securities for issuance as in a regular offering, but only issues the registered securities over time when it needs capital and when the markets are favorable. A dividend reinvestment plan allows existing shareholders to use their dividends to buy new shares from the firm at a slight discount. In a rights offering, existing shareholders are given the right to buy new shares at a discount to the current market price. Shareholders tend to dislike rights offerings because their ownership is diluted unless they exercise their rights and buy the additional shares. However, rights can be traded separately from the shares themselves in some circumstances. In addition to firms issuing securities, governments issue short-term and long-term debt either by auction or through investment banks. And that concludes primary markets. Up next, we examine the importance of secondary markets and their structures. Don't go away.